Hi, I'm Jarrad Brown, Australian expat financial planner based here in Singapore. Welcome to my video series where we tackle some of the tough personal finance questions for Australians living all over the world. Today I'd like to share with you some tips and separate the facts from the fiction when it comes to transferring money from Singapore back to Australia. Now, a lot of this will apply when it comes to transferring money from anywhere back to Australia. What we're going to go through are some of the key tips and key questions that you need to ask yourself. We'll also go through some of the common myths that we hear, just to dispel some of the fallacies that exist out there. So let's dive right in. The first consideration when it comes to transferring money back from Singapore or overseas to Australia is to review the double tax agreement with that country, or with Singapore in this case, and Australia. When it comes to Singapore, for example, if we're not deemed to be an Australian tax resident and instead we're a Singapore tax resident, then our income and our salary is solely taxed in Singapore. What this would mean is that if we decided to repatriate those funds back to Australia, there's not going to be additional tax on that money when it arrives in the country. Now, the same would apply for managed funds or shares or ETFs or other investments that we've made while in Singapore, that we bought and sold while we've been offshore. Now, it's important to review A, your tax residency, and B, the double tax agreement with your country of residence and Australia, and just make sure that you're not going to get hit with any additional expenses or taxes when that money lands back in Australia. The second consideration is your tax residency status. If you're not deemed to be an Australian tax resident, then your salary, your capital gains on any shares that you're buying and selling, or ETFs or managed funds, is not taxable in Australia. Now, what will remain taxable in Australia is any taxable Australian property, TAP or TARP assets that you have back in Australia. For most of us, this would be an investment property that we're renting out. But our salary, our other income, would only be taxable in Singapore or our country of residence. Now, if you're not sure about your tax residency, I would certainly recommend you consult a professional, seek advice from your accountant and/or financial planner, and just make sure that you're not going to get hit with any additional expenses or fees by transferring money back to Australia. Make sure also that you are filing tax returns correctly. If you're filing them, if you're not filing them and should be, please speak to your accountant, get some advice and get onto them quickly, because otherwise we may find that we get hit with late notices, penalties, fees for not filing our tax returns and paying tax on time. The third consideration, which is more to dispel a myth than anything else, is this limit of $10,000, this magical number. We see it on immigration cards when we go to Australia, that if you have more than $10,000 in Australian dollars or another currency equivalent, we must declare it. And that is correct. But that limit has no bearing on any electronic transfers into or out of the country. It may have one day, many, many years ago, but these days AUSTRAC will flag any money in or any money out of the country. So whether you transfer $1 or you transfer $100 million, as long as it's from a legitimate source, you should have nothing to worry about. If that's from your overseas salary, for example in Singapore, and you're only a Singapore tax resident, then there shouldn't be additional tax to be paid on that money when it arrives in Australia. Now, it is important that we just add a slight caveat here, and that is that if you decide then to put that money into shares in Australia or into a bank account that earns interest, you will have what is called withholding tax. Now, withholding tax on unfranked dividends is at a rate of 15% on those dividends, and on any interest it's at 10%. Now, again, just to be very clear, that's not a 10% of the amount we invest, that's 10% of the interest that is earned. So if we earn 1% interest, then 0.1% would be taxed in the form of withholding tax. Doesn't require a tax return, it would be automatically held and paid to the ATO for us. So again, just be clear on your tax residency status and just be aware that the limit really has no bearing. Now, the fourth consideration is the actual source of your funds. I've mentioned a little bit throughout this video that if it's from your salary in Singapore or from overseas and you're not an Australian tax resident, that money should not be taxable in Australia in most cases. If it's from shares or from property or from other source that you should be paying tax on in Australia, then you need to be aware of those tax implications, crunch your numbers, seek professional advice and work out if even there are ways to minimize that tax, and just make sure that you're prepared for any implications of transferring that money back to Australia. Now, if you are liable for tax in Australia, it shouldn't really matter too much whether you transfer the money in or not, but just make sure that you're filing your returns correctly and you're aware of any implications. Now, when it comes to transferring our money back, there are a number of ways. We can obviously utilize the banks. Most of them, for the most part, charge ridiculously high fees. So in most cases, I would avoid using your day-to-day bank because quite often we can find we're paying a lot more, whether in flat fee or what they call a spread. Now, the spread is the margin they apply to the current exchange rate, and that's where they earn their margin. So don't think that your bank isn't charging you anything because there's no flat fee. They'll be making their money somewhere else. So I would recommend speaking with one of the FX brokers. There are a myriad of great ones out there these days. We've got TransferWise, we've got Pay to Home, OFX, World First, Clarency. There are more and more popping up all the time, and the margins are getting smaller and smaller. Make sure that if you are transferring a reasonable amount, which I would say is anything over about $10,000, give them a call, speak with them, and ask if they can give you an even better rate than they might be quoting online. I hope you found these tips helpful. I hope it's helped to shed some light on transferring money from Singapore and overseas back to Australia. If you have any questions at all, please do feel free to reach out, shoot them through. We'd love to hear from you. Don't forget to subscribe. Thank you very much for tuning in, and I look forward to seeing you next time.